Joining me now to share investing perspectives on the Asia Pacific region, as well as positioning updates on Fidelity AsiaStar Fund and Fidelity Japan Fund, is Portfolio Manager Eileen Dibb. Welcome, Eileen. Great to see you.
Hi, Pamela. Great to be here. Thank you.
Delighted to have a chance to speak with you and everyone else who's here, and delighted to see you, Eileen. Please do send questions in over the next 30 minutes or so to ask her about some of the topics that we'll talk about here today. I mean, it's very much in the forefront of everyone taking a look at the story on stimulus. I mean, let's begin there. We're going to dig into tariffs as well. But the stimulus itself, the way it's targeted, the rally we've seen, there's a big question about whether it has legs. How do you take a look at that?
There are a couple of things that have been announced recently. Last we had the real estate market fall apart in China, and the government has kind of been coming out with different initiatives over time. Most recently, a debt swap for local governments. It brings some hidden debt onto balance sheets at a lower rate. Also, some incentive to invest in this stock market in China. And one of the things that was not as prevalent in the current round of stimulus was consumer. So looking forward, the question is, what does the Chinese government bring for the consumer, and how does it tackle that?
That's really interesting, because we mentioned sort of the markets and pivoting, and for a long time, the capital markets in China have been maturing, and there have been many measures to help that sort of guide that process. We know that's happening. The stimulus, some of it targeted there. I guess we might circle back to that. I want to ask how much is on hold until you and everyone else who would like to invest in China and take a look at it understands what the tariff policy will be going forward out of the new administration. Are we still on pause?
I think today China is on pause. I had read an article in the past few days that said it might be better for China not to be on pause, because you could stimulate now, you could continue to stimulate after we know what the tariff situation is in the US. But at the moment, there's no real push to get the consumer back in the market. There's been some push, but the question is, what's still to come?
Okay, and on that, I mean, there are so many different pieces to this. We've heard actually for years that China, in terms of its export best prospects going forward, it has been able to move manufacturing, sort of its industrial processes into different countries, so that ultimately it can still export either to the US or to the allies of the US without things coming directly from China with a sticker on it. That has happened. It's still happening. Maybe bring us up to date on sort of the moves China has made to protect its export market to the extent it can.
So I think there's two things there. One is the Chinese companies themselves, who have been shifting some manufacturing. Some of it has shifted to the US, some has shifted other places, but a bigger factor is what happens to companies that are outside of China, who manufacture in China. We have seen a lot of companies over the last, since the original round of tariffs on China were put in, moving their production to different places. Some have brought it to the US or Mexico or Canada. A lot of that went into Southeast Asia, so Cambodia or Indonesia or Thailand. There has already been production shifts. I think that whatever level of tariffs there are could continue to manifest that shift. And the question for the Chinese domestic economy is how much of that really happens, and what comes in to fill that gap if it does happen.
For some time, there's been attempts at a pivot, certainly, to create much more of a draw on demand from the domestic economy. Do you want to update us a little bit on the domestic demand for Chinese companies and their local consumers?
I think that there are definitely areas of Chinese domestic demand that have been hurt by the real estate market falling apart. Remember, real estate was a very big part of Chinese investment. And so People had their money there, but the Chinese in general, tend to be savers. There's a lot of money in Chinese savings domestically that, it's hard to unlock that if you don't have a place for that to go. So, one of the initiatives was to get some more money into the stock market. That was not traditionally a huge place for retail investors to put their money. And the other is to try to help the Chinese real estate market to come back. Once you start to see those pocketbooks opening, that savings coming out of the savings accounts and into the economy, there could be a lot of stimulus there, not only from the government, but from savings that are already existing.
And I guess to what extent could that offset trade issues, export issues? I mean, you're the one calculating that, and you're looking at companies, I'm sure, one by one and very carefully on this. But I mean, is sort of a question, is China still investable? I mean, you obviously think so, but tell us a little bit about that conundrum.
I think that China, if it does stimulate, if you can get savings out of the savings account, China can be investable. I don't think that, there are certainly pockets of China that might look better than others, that might not have as many issues with the tariffs. And that's really where we come in. That's really what I look at. It's really about picking those points. Where do you want to be in China? What does look good? Because, I know we're going to talk about tariffs, but there's currency involved. And the currency will respond to tariffs. There's a lot of different things that come into play. And, that's really what I do. And, at Fidelity, we do all day long is look for those pockets of growth or pockets of things that are recovering and figure out what those companies are. And so, yeah, I think, having China as an investment, it's actually a large part of the AsiaStar benchmark, is one of the things that I really do need to look at and keep on top of all the time.
So let's dig into the strands of the tariff story. It's a global story. Every country really is positioning or getting ready in some way to expect tariffs because they've been told to. What are you reading? What are you digging into to understand this? Are there sort of one or two, three key areas that you're watching carefully that you could share with us?
Sure. Probably one of the biggest things that I am focused on is, does this become inflationary? What does that do for rates? And one of my colleagues, Denise Chisholm, who I believe you probably know
all the time, yeah.
I know, I love it. And Denise was doing a session yesterday or the day before for us, and the conversation was, where are the offsets to tariffs, and what happens with when you have new tariffs in the market? And her point was that over time, tariffs are not necessarily inflationary, because even though you're paying more for some things, if you're paying more for those things, you're going to pay less for other things. And therefore, the supply demand over the overall economy actually tends to even out. And so does it become inflation or does it not? What are the offsets? I think those are some of the really important things that I need to think about. We need to think about going forward, because, in the last round of tariffs, the Chinese government did devalue the currency. That can offset part of the tariffs. And then what does that mean for domestic companies? What does that mean for international companies? What happens to the EPS numbers and the valuations of stocks that are involved in this? And does it really become inflationary, or do you, at the end of the day, with these offsets, not really see the inflation that automatically, in my mind, comes to the forefront? So there's a lot going on there until we actually see what the tariffs are, how big they are. Is it global? Does it become a trade war? There's a lot of things that will go into that calculation of what we're looking for, what I'm looking for, and where we go from here.
You mentioned earlier on, I just want to pick up on Chinese companies have been positioning themselves to do manufacturing in different countries actually for some time now, for years. Those that have either relocated some operations or have a branch or an arm or operations and so on in the United States, which by many, probably consensus account, is going to do well economically. Is there a little bit of rising, all boats rising there with Chinese companies based in the US or operations based in the US as well?
I think it depends. I think, if companies bring operations to the US, it's not always the most efficient use of resources. I mean, labor in the US is not always the cheapest labor around. And so does it bring all boats up? Maybe it brings, certain boats up. I was reading something about one area that, in the US that was having some production coming in under the IRA, which is one of the policies that's been in place. And if you take that away under the new administration, does that company, the company that was coming into that area still come? So there's a lot of things that could go into this equation, depending on what policies come with the new president. I promised you that I was going to try to not say we have to see what comes more than 3 times. I'm not sure I'm going to get away with that in this webcast, but there's so many things that are going to come in the next few months that, depending on what current policies are rolled back and what new policies are put in place, we could see a really different outcome in terms of different geographies, different small towns where maybe something was in the works because it worked under current policy, but now it goes someplace else. I'm not sure all boats are going to rise from this. I think that there are certain boats that are going to rise. I think there are certain boats that might sink. We'll have to see where all of the policy comes out.
And you are very careful about looking at all these things for all the investors joining you here today. Can you just remind us a little bit about your process, how you go at that? It seems almost especially in light of the fact that things are changing. How do you sort of spread out and look and turn over rocks? Just give us an update.
So I do have what I call my process, and that does take into account a lot of different things. So all of the macro that I can read about, all of the things that are going on in Asia, are going around the world, policy, politics, all of these things are things that I do consider on kind of a top level. And then you have all of the analysts that work at Fidelity who go out and are traveling and turning over rocks to look for new ideas and to keep abreast of current names in both funds. They have a huge impact on what I do on a day-to-day basis. And in a regular week, I will talk to usually 1 to 2 a day, analysts in Asia or Boston or London or someplace that, are covering either stocks that could make it into the funds or stocks that are in the funds. And then the process goes from there. I have quantitative screenings that I use. I have fundamental screenings, and my process usually comes at the end of the day. Those companies that are going to grow their EPS either at a rate that I feel is very competitive, taking all those things into account, right? All those things, the macro, the analyst input, their recommendations, and really trying to look for companies that have valuations that back that up. I think we've talked about my valuation metrics in the past. I tend to use an ROE and price to book construct, which is a little strange for a growth investor. But I do feel that the earnings are captured because I'm looking for earnings streams. Then I put a valuation on that's not quite as volatile. So if I have a company with an ROE that's going up and a price to book that looks reasonable on forward price to book, which incorporates earnings, that's really what I'm looking for.
That's fantastic. And thank you for that. And I'll use this, a number of questions coming in, but I'll use this one to sort of pivot our conversation a little bit more to other parts of the Asian region where you invest and so on. So here's a question just to open it all up. Have you seen any increased chatter, or do you read about any on the new BRIC currency idea, its impact on Asia? There's been a recent conference. What do you make of all that?
Sorry, what currency?
BRICS.
BRIC?
So the BRICS currency conversation.
I have not really focused on the BRICS currency conversation. I look a lot at currencies in general in terms of what will end up being a reserve currency. What happens with rates in the US if rates continue to stay high, what happens with treasuries. But Pamela, I have not really focused on the BRICS currency discussion.
Okay, so that was just a question coming in. Let's branch out a little bit into positioning through themes, if you don't mind, if we'll begin. Everyone's investing in AI. Everyone's looking at it or looking at investing in AI if they're not actually doing it. Take us through some of the themes that I'm sure are themes that we're living every day as well, that you're investing in, and then we'll kind of go country by country as well.
Sure. One of the biggest things around AI is the sheer amount of computing power it takes to run AI models and to incorporate AI into business streams. And that's a big thing across Asia, because you not only need utilities to have more capacity, you need distribution and transmission of energy. You need data centers to house all of the inputs. I was reading something that said you could spend $1 billion just teaching a big AI model to do what you want it to do. That's a large amount of money, and it takes all of these things together. So some of the places that I've been looking to invest are around those data centers, are somewhat around utilities, are around tools that are used to make data centers and utilities. And then also some of the chipsets, because there's obviously sort of the NVIDIA set of chips. There are also ASICs chips, which I think we've talked about on this call before. And what really comes down to, at the end of the day, being the correct setup for AI to happen. And then, is it overdone? Are we really going to get as much AI in businesses as people think? And that's a big question.
So that's one of the themes that, and as you say, it infiltrates lots of different sectors as well. That's something globally. Take us a little bit into the different countries. So we know that India has had an extraordinary run. It's an expensive place to invest, has a lot of very good companies from what I hear from you. Is within the All Asia, just sort of tell us about some of the country positioning.
Yes, so I have been underweight India. It's been a long-term conversation. India continues to do really well. Growth is there. It's got a rising middle class. And I continue to look for names that are attractive and should do well going forward. Other countries that might do well in a tariff regime are, for example, the Philippines. We were underweight the Philippines for a while. We're now overweight the Philippines again. It's relatively small in the benchmark, but it tends to have a lot of things going for it right now. And domestically, it's a little more domestic, so it doesn't depend quite as much on global growth. And then, I think that I have a lot of exposure to banks around the region and financials. So, just looking around the region, some of the biggest positions in both AsiaStar and the Japan fund are banks. Rising rates are good for that. And I think that I was telling someone the other day that the Singapore banks have outperformed a lot of other places in the world, and we've owned some of that we've been nicely overweight Singapore banks and Japanese banks, and we own some other banks as well. But just taking all of that into account and saying, there are definitely countries that look good, but also sectors within those countries.
Fascinating. And do you find a lot of investors are approaching you to look at potentially, I mean, I don't know if this is correct, you'll correct me, but sort of the tailwinds of China not having a great time currently, and therefore Japan? I mean, that's been going on actually for a few years. Does that continue to play out, those pivoting to Japan because China's not in a great spot?
I think it's been a definite factor in the last year and a half. We have definitely seen flows into Japan, and if China comes back and stimulates and does all the things that it might do, we could see a shift again. But Japan has also had a lot of self-starting going on. Their corporate governance has improved substantially over the last few years. Companies have really gotten religion around shareholder returns. This is something that I've been looking at for 2 decades, have written on it, have talked about it. And I think change in Japan has been really substantial, and not just versus the rest of Asia, but also versus certain places in Europe. And so I think Japan continues to attract attention. Obviously, there have been some companies in Japan that have had really solid performance and good runs. And that's sort of where my process takes me is when things have done well and have had outsized gains, then we sell them, go into something that's not quite as frothy maybe. And so I still think that Japan is interesting. I still think that there's a lot going on there. We continue to be overweight Japan in AsiaStar.
Fantastic. Okay, excellent. There's a question here talking a little bit about concentrations within the funds that you manage. So how concentrated are they? Are there any maximum allocations to a particular stock, for instance? Could you give us the broad strokes there?
I think that there are some general, I think if we get to a really large position of like 15%, something probably would kick in, but both funds are very concentrated. Both funds have 30 to 40 names. It is, I believe, the way that I can add most value for my clients and my shareholders. I think that, owning names with conviction in size, I think that works over time. And, this has been a long run move for me where I didn't always manage funds or portfolios with 30 and 40 names in them, but over time it just has felt more comfortable. So there are large active weights in stocks, there are large active weights in countries, there are large active weights in sectors. And over time, the performance has shown that I make money generally in our overweights and in our underweights. So knowing what not to own is helpful, not knowing, but not owning the things that I think won't work helps. And then owning the things that I think will work helps. So I try to make active weightings on both sides of the coin. So I don't feel like owning everything because it's in the benchmark and I have to own something is really going to add value for my shareholders over time.
Fascinating. Thank you for that. Tell us a little bit about, there's a story with emerging markets. It has a lot to do with the dollar, actually, with the strength of the dollar. You talked about currency earlier. Are there some emerging markets that are in the funds? Are there particular areas of that are of interest? You can just update us there.
So I think I look at the dollar as the base currency. I know that these are Canadian mutual funds, and so things get translated back eventually into Canadian dollars. But in order to look at stocks across regions, there are a bunch of countries that are pegged to the US dollars. There are countries that are completely free floating. And of course, with emerging markets, you run into the, whatever is happening globally with inflation. If you could get potentially stagflation, what does that do? I incorporate that both into our earnings estimates and where we're looking for stocks, and also in the absolute stock return that's expected. So if there are emerging markets currencies that are expected to weaken because they're either weakening because of the tariffs or weakening because of the economic situation, and maybe those countries can't back their currencies as highly. Some of the developed countries, like Japan, backs its currency when it weakens too much. That all goes into where I invest. So I am looking for things that will outperform everything else in the region. And currency comes into that because if you have a Hong Kong stock in a US, which is, pegged to the US dollar and a currency that is not really weakening, maybe that does outperform a stock in a different emerging market, for example, where the currency is going to weaken and that stock on an absolute basis does not do as well. So all the currency comes into effect. It's going to be an interesting few months to say, if we get inflation, if we get stagflation, if we get, what happens with monetary policy in all of these places? How do rates go? This is going to be a really interesting few months and a lot to watch and a lot to take into account. And at the end of the day, I view my job as reacting to all of that and saying, these are still the best places to be. Some of the stocks will go out of the funds, some will come in, and really say, this is where I expect the next few months or years, generally years, with the holdings and the funds tend to stick around for a while, to be the best places to be.
Well, we know that you'll be watching all of that with great interest for everyone else. So we're delighted to know that is of great interest and actually will be fascinating for you to watch and obviously make changes where needed to lean in and to lean out. Do you watch the markets overnight?
I try not to. I do need my sleep.
I'm so glad to hear that because that's probably doesn't last for too long. Eileen Dibb, a delight to see you. Thank you for joining us.
Thank you, Pamela.